to the last topic of the class 2, which is the WACC, weighted average cost of capital. For weighted average cost of capital, or the WACC, the formula is provided to you in the formula sheet. Okay, it is multiplying the cost of various sources of finance used by the company in terms of their proportion of total market value of a company. So some keywords I would like to highlight here is the various sources of finance. So you can see we have we use KE, okay, KE, which is cost of equity, and KD is cost of debt. Different sources of finance. For example, if you have the preference share, and also the second one is convertible loan notes. Okay, then you have to add them back into your WACC calculation. Okay, because here is the various sources of finance, so don't ignore them. For preference share, okay, let me ask you, for preference share, please remember that the preference share dividends has no tax benefit. Okay, for convertible loan note, so for the interest payment to the debt holders, okay, the interest has a tax relief. So all these items you have to have a very clear mind, okay, because the formula sheet only provides you the concept only. You have the equity, you have the debt, okay. But if it has more sources of finance, like if the company can issue convertible loan notes, preference shares, ordinary shares, and also, for example, bank borrowings, or issue the corporate debt, then you have to include all items in your WACC calculation, okay? Because different sources of finance should be consolidated into the working. And the other one is the total market value, okay? Because you can see we have VD, okay? It's the market value of different portion, like the market value of equity, the market value of debt, or if it is the preference share, then you have the question will provide to you the market value or the value of the preference shares. Okay, why WACC is important? Because the WACC is an idea that this rate is used to calculate the NPV of the project. Okay, so why WACC is adopted? Because it is important to use the WACC to work on the NPV of the project. If the NPV of the project is positive NPV, so the project is benefit to the companies or to the shareholders as well. Okay, because it can help to push up the share prices. So here is the important part. Okay, WACC, why WACC is important? Because it is used to calculate the NPV of the project. And the entire justification for the use of the current WACC depends on the reviewed preference concept. That is, in a perfect capital market, okay, the assumption is the WACC calculation is based on the perfect capital market. Investors are satisfied with the return they are earning. Okay, so what's the limitation of WACC? The WACC is limited to evaluate the projects like the NPV that do not change the risk of the company. Okay, we will talk these parts more specific later, but right now we will introduce to you for WACC. Okay, it consider about risk. Okay, it consider about risk. So why NPV method is superior to other methods like IRR or non-DCF method? Because NPV method include two parts. First of all is the cash flow. Cash flow will increase the shareholder wealth. Okay, it's very obvious because cash flow, the generate cash flow can help the company to pay the dividends to the shareholders, in which it can increase the share prices. Also, when the NPV is calculated, the discount rate we adopt is the WACC, the weighted average cost of capital. And the weighted average cost of capital is considering about the current risk of the company. So yes, the limitation is it do not change the risk of the company, but it has already incorporated business risk and financial risk. Okay, so here the most important part, because especially when you use CAPM, the capital asset pricing model. Okay, remember the beta. Okay, the beta is about the risk. It's about the risk. So when you use the capital asset pricing model to estimate your cost of equity, then you have already considered the risk, the financial risk and business risk. Okay. So for the WACC here, the limitation is because it assumes all the projects have the same risk as current operations. So same operating risk as existing projects. Okay, for all projects considered in future investments, the risk is considering the same, no change. Second, finance in the same way as existing projects. So the gearing should be the same. For example, if a new project requires the funding is $200 million, then the current gearing ratio is, for example, is 30% will be financed by equity and 70% financed by loan. It means the 200 million investment projects will be financed 70% of loan. It means 140 million will be coming from the loan or the bank borrowings, and the other 16 million is coming from the retained earnings or the shareholders' funds. So it means same gearing of any projects to be invested. And third one is the finance is not as project specific. For example, low subsidy, etc. Okay, so there's no specific financing in a particular project. Okay, and for here, we start to discuss about the risk. So students, okay, my friends, remember here, okay, we'll go into this part very soon, okay, on the next lecture. So here we start about the risk, because for the risk topic, okay, it is very obvious or very common for the ACCA F9 exam papers showing the discussion question about what the risk. Okay, the risk, because here we share about the business risk and financial risk, and for the WACC we talk about it has no it assumes the new projects to be invested has no change in the risk of the company. We talk about risk. So in next lecture, if you are weak or you are not prepared or you are not familiarized with the risk topic, okay, just prepare for example, study to read the study test or our course note first, so that you can have a better understanding before the lecture start. Okay, let's coming back here. For WACC, with the average cost of capital, here we will show you an example how to get numbers, the WACC, based on these examples. And in this example, we'll share with you how to get the answer for cost of equity and cost of debt. Okay, let's read it first. Okay, welcome back. For this illustration, okay, a company called Custer is trying to decide on a cost of capital to apply to the evaluation of investment projects. The company has an issued capital of 500,000 ordinary shares. So the number of shares issued is 500,000, and the current share price is 117 cents. Okay, it has also issued $200,000 of 10% debenture. redeemable in 2 years' time with current price of $105.30. Okay, so redeemable bonds or redeemable debenture means if you would like to find the cost of debt, the IRR method should be applied. So let's check how to estimate the cost of equity. What information is provided? The ordinary dividend and debenture, okay, the ordinary dividend and debenture interest are due to be paid in the near future. The ordinary dividend will be 60,000 this year and will be 5% more. Okay, 5% more each year for the foreseeable future. What is the cost of capital? It means the WACC for custom PLC. Assumed tax rate is 30%. So here, the cost of that is by what? By IRR calculation. Okay, you find the IRR, then you can come to the cost of debt. And for cost of equity, okay, because the information provided is about the dividend, it's about the dividend growth rate, and also the current share price. So you can adopt the dividend growth model or dividend valuation model. Okay, so identify which formula you have to apply so that you can check the formula sheet and then you can work it on in your working. So here we share with you how to get it done. Remember, for WACC, it's based on various sources of finance with their proportion of the market value. So first of all, we need to find out the market value of different parts. Okay, remember this formula? This formula, okay? We need to find the market value of debt and equity. Here we found the market value of equity. Okay. The current share price or the P0 is 117, and the dividend will be paid, right? The dividend to be paid is 60,000, and how many shares entitled to the dividend is 500,000. Okay, so we funded the ex-dividend price. Okay, if I work it on, is 117 minus 12 cents, right? So it is 105, the ex-dividend price. And with ex-dividend price 105, then you can find times the number of shares issued. You can get the V, the market value of equity, which is $525,000. Okay, next part is VD, the value of debt. The value of debt, okay, here the current price is 105.3, and it is before interest paid. So you have to deduct the interest by $10. Okay, so the current price is 93.5. Okay, and I will divide it by 100 because the face value of a debenture is $100. times the face value, which is $200,000, which is provided in the question. So the market value of this is 190,600. And for ROE, as I explained to you, the question information provided is about the dividend growth rate, is about the P/NOR, the current share price is also including the dividends. So you based on the information provided, it's much better for us to estimate the cost of equity with the dividend valuation model. It is provided in your formula sheet. In the formula sheet, it is D/NOR times dividend growth rate. Divided by the P/NOR plus growth rate. So here we got the information for the dividend. We know it's 12 cents times the growth rate is 1 plus 5%, which is provided in the question paper, and the ex-dividend price is 105 times 5%. So the ROE is 17%. And for RD or the KD, the formula sheet show is KD. For KD, it's a 10% debenture trading at discount, right? Because the price including interest is 105.3 and ex-interest is 95.3. So it's a trading at discount. Then the yield should be based on the linear interpolation. Assume 2%. One scenario, the other is 15%. At year 0, year 1, and year 2. The cash flow is minus 95.3, and for year 1 and year 2 is 7 after tax. After tax is 7, and for year 2 you have to repay the principal by $100. So the factor we use annuity factor for the interest payment. So here is 1. Here, if you check the table, is 1.942, and here's discount rate for 2 years is 0.961. For 15%, we adopt 15% is 1 for now, and then is annuity factor is 1.626. For 2 years, present value factor is 0.756. So here we got these numbers. 93.6 for now. You have the cash outflow. If for example, if the market price and annuity factor you use $7 per year times this annuity factor, so you got 13.594, and for 2 years repayment, okay, is 96.1. So you got how much? Is 14.4. And for 15%, okay, follow the same logic. I'll work it out to you. Is a minus number. Okay, I just put 8.3. By linear interpolation, okay, by linear interpolation, this formula get it. Okay, remember, we use the after-tax cash flow, so there's no need to work on any tax adjustment here. You get 10.2% on the cost of debt. So you got all numbers, 10.2%. For cost of debt, you got the equity is 17%. So you can get the WACC, the weighted average cost of capital, easily. Okay, for the WACC, you have 17% of cost of equity times the market value, which is 525 for the equity part, and divided by 525 plus. Okay, and for cost of debt, because it's tax adjusted, so no need to do any tax adjustments. Here is the valuation, the debt value as a proportion of total company value. So it's about 15%. Okay. So here we finished the illustration of WACC. Let me recap for it. How to work on this question if the paper is asking you, the ACCA F9 exam paper asking you about the calculation of WACC. First of all, you read through the question and decide what formula that you have to apply. For example, if it is redeemable debentures, then cost of debt, use the IRR, the internal rate of return. And for cost of equity, if the information provided is about the dividend growth rate and the share price, then you adopt the dividend growth model. Then you can come to the cost of equity for this part. And don't forget, the WACC is the weighted average between these two costs, the cost of debt and cost of equity. So you have to use the market value of each source of finance. Okay. And don't forget, the question may provide you more than two sources of finance. Cost of debt, cost of equity, maybe cost of preference share. Then you have to put them all together in your calculation. And then you will work out first the value, the market value, okay, for each source of finance like the equity or debt, then you can, second part is work on the cost of equity, cost of debt individually. So finally, the WACC. Okay, you just put all items in the one formulation. And one more reminder to you is about the cost of debt. If you use the before tax cash flow here, so you no need to adjust any tax in your formula. Okay, because the formula, you still remember, we show here is there's a cost of debt with adjusted by tax. So you can work it out, for example, by before tax cash flow, and then you can adjust for the tax in your calculation. Okay, but remember, linear interpolation is the suggested method to estimate cost of debt because it is the same as the IRR. Okay, so we finish, and then we come to the summary part. And in this class, we share with you about what is capital rationing, how to work out the single period capital rationing. Okay, we go through the lease versus buy. We go through the replacement policy. So all these items, the capital rationing, lease versus buy, and replacement policy are the special topics in the investment appraisal. Okay, in my experience, okay, this topic will be examined, will be put in the exam paper, maybe in section B or section C. Okay, it's quite often for the examiner put these questions. It may be put one of these topics in section B. So you can check your past paper to check whether you have good understanding on this topic. And next is about the investment appraisal. Under risk and uncertainty. Okay, under risk and uncertainty, we share with you what is risk. Risk is you can assign the probabilities. Okay, you can assign probabilities. Okay, you can assign probability. You can work the math on it, but for uncertainty, it cannot do it. Okay, for the method, for example, we share with you what is sensitivity analysis, what is the expected NPV. For expected NPV, it can be handled for the risk because the probabilities are assigned for the sensitivity analysis. It is a scenario case. For example, in each sensitivity analysis, one variables will be selected to test how sensitive to the NPV. Okay, it's about the uncertainty. Okay, to test it. And also we work out what is simulation model, okay, and then we move on to the WACC, the weighted average cost of capital, and also the cost of capital structure, the cost of capital. We present it, okay, we introduce it by sharing with you different formulas or different equations in the formula sheet, the dividend growth model, or the dividend valuation model, the growth approximation, and also the capital asset pricing model, the CAPM. Okay, all these formulas are helping you to estimate the cost of to work on the cost of equity of a company. So we work on the cost of capital by cost of equity, ROE or KE. Okay, the cost of equity. So cost of equity, we have different valuation model. And also we have the CAPM. Okay. And we also went through the cost of debt. Okay, for redeemable debt. Okay, use the IR formula. And also we go through the WACC. Okay, we also go through the WACC. We also went through the WACC, and I think you are familiar with it. Okay, some supplementary information that I would like to share, maybe I write it down in this page, is about the knowledge of debenture of the bonds. Because I forget to share with you on this some basic information about the bond. Remember, for the bond or debenture, the face value of the bond is 100. So you can see, for example, we say 100.05 the market price. Okay, it is selling. The bond is selling at premium because it is against $100, say. And if say it's $4.96, then it's a discount. The face value is $100. The bond market price quote in the market. Okay, this is market price for bond quoted. Market price is quoted in bond market. Okay, so we have the yield. Okay, we have the yield. For example, when we work out like the face value or the debenture, the interest is 10% debenture. Okay, the yield is may not be 10%. Okay, because the market price, for example, is lower than 100, is 96. It's 96. Then the yield is different from 10%. This is the yield is the current bond interest rate. Okay, we just mentioned here. For example, here we share about the cost of debt. Yes. The pre-tax, for example, the pre-tax cost of debt is here is about 6.3%. It's about the yield. It's the yield. Okay, it's different from 5% interest. Okay, it's different. We talk about the yield. So in the cost of debt, we calculate the yield of a bond. Okay. Okay, so here is some supplementary notes for you to understand about the bond or debenture. I hope I have to apologize because I just forget to introduce this concept in the cost of capital part. But I hope, okay, this final information is helpful to you to understand what's the financial management or financial markets about the debenture and bond, and we will cover it in the sources of finance. So don't worry if you are not very or you are not very clear about this concept. Okay, we'll coming back here in the sources of finance topic. So here is for the class 2. Okay, see you next time. Thank you.